Right. Today, we are just going to focus on the first question. I would want to believe that each and every one of us has got the question paper. If you do not have the question paper, the handwriting is there on the wall. I think everyone is reading the question. It is very, very important to do this question, to submit the short essay, and to make sure that you pass it. Do you know that if you do not get a sub minimum in your short essay plus your KCQ, you will not qualify for the online assessment. So it is very essential that you pay particular attention to the short essay, the one that you are going through today. So every mark counts. You only notice that every mark counts at the end of the year when you've got 74% and you're only missing one to get a distinction. That's when you say only if, only if, only if. So never ignore any mark. That's why it's there. It counts. Every second counts. Every mark counts. All right. So this is the question that we have. Tomorrow we'll do question number 2. Question number 1 says, the following information was extracted from the accounting records of Leeds Limited for the month ended 30 April 2021. There is no inventory at hand at the beginning of the month of April for Leeds Limited. The total expected production and sales are 75,000 units and 70,000 units respectively. What it means is production is 75,000 units and then sales is 70,000 units. Then the selling price per unit is 12 Rand. The company expenses can be broken down as fixed manufacturing cost, variable manufacturing cost. You can see the wording that is in the list of the expenses that is given there. They only differ by 2 words. One is fixed, the other one is variable. One is fixed, the other one is variable. So this topic on absorption costing and marginal costing is derived from the very, very, very basic chapter, which is, I think, your unit 1 in your syllabus, which talks about the classification of costs. And it says here, costs can be classified according to their behavior. As output increases, what is the behavior of your costs? Costs can exhibit 2 behaviors. One, they can be fixed, meaning they do not change as output increases. As output increases from 0 to 1,000, it means that the cost will remain the same. Let's say I am selling magwinya in a room. If I sell 1 gwinya, it doesn't change the rent that I'm going to pay at the end of the month. If I sell 10 magwinya, it doesn't change the rent that I'm going to pay at the end of the month. If I say 1 million magwinya, it doesn't change the amount of rent that I'm going to pay. It therefore means rent is a fixed cost. It does not change with the change in output. So when you classify your costs, you are classifying them according to fixed costs and you're classifying them according to fixed costs and variable costs. All right. I don't know now, guys, if this lesson is cut because of 40 minutes. I don't know how I'm going to share the next link because WhatsApp is not working. If someone has got an idea how I can share this, the next link. All right. I will think of ways of sharing. I know I've got a group, but I don't know how I'm going to share it because WhatsApp is down. But anyway, we can devise ways. Right. So variable cost, it means the cost to change with the change in output. If you buy flour to make the magwinya, the amount of flour that you use is going to change with the amount of the magwinyas that you are going to make. So you are classifying your costs into fixed costs and variable costs. And the 2 methods that are listed here, we have got an absorption costing method and the marginal costing method. When we say absorption costing method, this method, it takes into cognizance all the costs that are involved in the manufacturing of a product. It means if you are valuing your inventory at the end of the year, you have to include both variable costs and fixed costs that has been incorporated into your product. Hence the word absorption. Everything that has been absorbed by a product It's used to find the cost or the value of a certain unit of output. Then marginal costing, marginal, it means marginal means extra. It means what is actually the change in the cost as a result of the production of an extra unit. So here on the marginal costing, you only include variable costs. Hence the word marginal. It's also called the variable costing method because they are only including variable costs. All right. Any question on where we are before we start on the absorption costing method? Any questions so far? Any questions so far? All right. Someone is saying I can share on the chat. I don't know if it's possible to share on this chat. I would try to use the same on Teams. All right, let me do this. My email address is, you can use this one, dtries7@gmail.com. All right, that's my email. So if this one cuts, send me a message on that email address, and then I will make sure that I will respond with the link if this link stops. All right. So let's proceed, guys. Yes, Olotu?
Can you please repeat your email address?
If you check on the chat, just check on chat, I've written it on chat. You can use that one, thanks. or you can use this one.
Hi, Jasper. Nothing has come through on the chat.
Yes. On which chat? Is WhatsApp back?
On the Zoom chat.
On the Zoom chat, okay. All right, guys. So let's start. Let's start with this one. I want a clean sheet. Everyone has got a question. Is there anyone who doesn't have a question? Is there anyone who doesn't have a question? Because I'm going to make that question disappear so that we can all look at this. Everyone has got a question, isn't it? All right. I think silence is also talking. It means we are in agreement. All right. So I'll stop sharing this and then share the Excel. Right. This is my Excel sheet. Am I visible on the Excel sheet? Then I'll start with absorption costing. So one thing that you must know on absorption cost, you have to know what we call the pro forma, which is the format that you use in absorption costing. So the first thing should be your sales. Okay. And we are told that your sales is 70,000 and sales per unit is 12. Is that right, guys? That's your sales. So you have to say that one is equal to 70,000 multiplied by 12. Then you find your figure there, 840,000. Are you following? This is the pro forma. Then, if it's absorption costing, you have to say less manufacturing cost of sales. You have to say less manufacturing cost of sales. But we don't have this figure of the manufacturing cost of sales because we needed to calculate it. But to calculate that figure, we have to start with opening inventory. What is the inventory that you started with? There is a statement here that says there is no inventory on hand at the beginning of the month of April. It means opening inventory is 0. It means we put a 0 there. That's opening inventory. All right. After opening inventory, we now need to put production costs. And remember, your production costs will start with fixed manufacturing fixed manufacturing production. Right, they've removed the 40-minute limit. I think they've given us bonus. Okay, fixed manufacturing production cost. So the fixed manufacturing production cost is given there, which is 34,500. So we put 34,500. Then the next thing, we need also to put variable manufacturing cost. Variable manufacturing cost. And the variable manufacturing cost, we are told that per unit is 3.30 Rand. Then we multiply by the production. How many units were produced? I want someone there to tell me how many units were produced.
75,000.
75,000. So we come here and say multiply by 75,000. It's good to show your calculations right there in the details column so that you know how you have derived that figure. So we say equals 75,000 multiplied by 3.3. It gives you 247. Then this is now manufacturing goods available for sale. What does it mean? It means all the goods that are available for sale are equivalent to this amount plus that amount plus the amount of the opening inventory. But we do not have now the amount of the opening inventory. There was no stock from the previous month. So what do we add? We just add the fixed manufacturing production cost and we put it there. Then the variable manufacturing cost, we put it there. Then the total becomes manufacturing goods available for sale. These are goods that are available to be sold. But not all of them were sold. That's why we use the 75,000 here, because 75,000 were produced. But we need to say less closing inventory. We need to say less closing inventory. But your closing inventory is how many units? Someone to show me. Your closing inventory is how many units? Chikon.
Oh, I'm just looking for the question.
I think everyone should have the question in front of them. It has been posted in the group on WhatsApp, so you can still open it.
5,000 units.
Yes, 5,000 units. Thanks, Shamil. 5,000 units. But we now, this is where your absorption costing differs from marginal costing. It is in the calculation of the value of the closing inventory. That's where it differs. In absorption costing, we include all the costs that have been involved in production. But in marginal costing, only include the variable costs. So here we include all the costs. So all the costs amounted to 282. 280. Sorry for that. Yep. So it's 282 divided by how many units were produced? 75,000, which is equals to 3.76. So we are multiplying your 5,000 by 3.76. This 3.76 is the most important figure. You see that one? The most important figure. That is the figure that differentiates men from women. That differentiates champions from winners. That differentiates the people that do exceptionally well and the average doers. Because with the absorption cost, you take this, the total manufacturing cost of goods available for sale, then you divide it by the number of units that have been produced. That is absorption costing. When it's marginal costing, you only use the variable cost per unit, which is 3.3. Here you have to use 3.76 because also the fixed costs have been absorbed in the closing inventory. Is that point clear?
Sorry, Jasper, I just have a question. How do you get to the 5,000?
All right, Shamel, please tell us. It's Shamel who started with that one. I know, but I think it's better if you are answered by one of you.
I think it's the sales unit, the 75,000 less the 70,000 unit.
Exactly. Who had asked the question? I want to address you by name.
It's Whitney.
Okay, Whitney. Look, we are told that the production was 75,000 units and sales was 70,000 units. So if you produce the 75 and you sold 70, what is your closing inventory?
5,000. Okay, I get it.
Good.
Thank you.
All right. So now we are looking at the value of that closing inventory. And the value of that closing inventory is 18,800. How the unit cost is 3.76. Why? Because we are also including the fixed cost it has been the amount of this fixed cost has been absorbed in the inventory. But when we subtract here, we then get the answer of manufacturing cost of sales here. Then we say this one subtract this one. Then we close your bracket. Then we get that amount. Okay. So here we should block and put it like this. So this figure, I want to put it in italics and make it bold. It is the manufacturing cost of sales. Because you have removed the fixed cost, the closing inventory here, what is left is now what has been sold. So the cost of what has been sold is called the manufacturing cost of sales. Then when you subtract it here, it becomes this one. Subtract that. It becomes your gross profit. It becomes your gross profit. Right. So that is your gross profit. Is that clear? Is that clear, Whitney?
Yes, it is. Thank you.
All right. Then the next thing, we need to say less other costs. And these other costs are also called overheads. These other costs are also called overheads. And we are going to start with, these are now administration costs, administration and selling costs. So we are going to start with the fixed selling and administration costs. Fixed selling and administration costs. How much do we have fixed selling and administration costs? Someone to tell me?
32,000.
32,000, yes. Then we also have got variable sales and admin. But because they are variable, it's 1 rand 0.45 times. What do we multiply with? Do we multiply with the 70,000 or we multiply with the 75,000? Because we are given the unit cost there. What do we multiply with? 70,000 or 75,000?
The 70,000.
70,000.
Yes, the reason why are we multiplying with the 70,000?
Because the total expected sales is 70,000.
Yes, because these are selling expenses. We multiply by the number of units that have been sold. So we say equals 70,000 multiplied by 1 rand 45. What do you get? You get that amount, and we have to put these ones in a block like that. Then this one is equals to minus sign this one plus that. Right. Then we get that amount. After subtracting those two, you should get your net profit. You should get your net profit. So equals this one, subtracts that. So this one becomes your net profit, and you put it like this. Let me rather put a double line. Let me rather do this. Right, something like that. Okay, that is your absorption costing. That is your absorption costing. Any question there on absorption costing? Any question? This is how you present it. Exactly like this. Exactly like this. Let me put this one in italics, bold and italics. Right. I think you can see the difference the moment we do the marginal costing. So let me put marginal costing here. Let me put marginal costing there. Right. After putting marginal costing, the first item is always the same, which is your sales, which is therefore your 70,000 multiplied by 12. And we have already done that, is equals to that amount. Are we fine there? Are we fine, guys?
Yes, we are.
Okay. Right. Then the next thing, instead of saying less manufacturing cost of sales, we have to say less variable costs. Because
Jasper,
yes.
sorry, Jasper.
Yes.
Somebody just posted in the group that we don't understand something.
All right, let me see. I didn't understand when you were explaining about fixed administration. All right. But the first question was from where? Where did you get the 5,000? Where the 5,000 has been explained. Did you get it? Did you ask this question before it was answered or after it was answered?
Before.
Or before, so it's answered now. Eh? Then the next one, I didn't
Yes, thank
understand
you.
when you are explaining about fixed administration. So when you are talking about fixed administration, let me give you an example of a fixed administration cost. Let's say there's a receptionist. You have a receptionist, whether you produce 2 units or you produce 100 units. The salary of the receptionist will remain the same. That is a fixed administration. So we call these ones overheads. They are periodic costs. In a month, they remain the same. That's why they are called selling, fixed selling and administration costs. Okay. I don't know if you answered, Marjorie. Are you answered there? All right, let me see. Bitumelo is asking a question. I can read this one now. No, it is. All right. Can we proceed? Okay. I hope the silence means we can proceed. So we say variable cost here, but we don't have the variable cost. So we start with opening inventory. Opening inventory. And your opening inventory is 0. Then from opening inventory, we will start with the variable manufacturing. Variable manufacturing cost. And your variable manufacturing cost is equals to 3 Rand 30 times 75,000. And we have already calculated this, which is equivalent to this amount. We've already calculated it. But remember, this is marginal costing. And we first of all deal with variable costs. Thereafter, we deal with the fixed costs. Because if you're dealing, I don't know whether you've already done issues of marginal income, which is your break-even point. If you say your sales minus your variable costs, you should get your marginal income. So the first step when you're doing marginal costing is to get your marginal income. So you have to subtract your variable costs initially. So if you add these two, equals the opening inventory plus the variable manufacturing cost, you get the variable manufacturing cost of goods available for sale. You get the variable manufacturing cost of goods available for sale. Then from there, you have to say less closing inventory. Okay, you have to say less closing inventory. And closing inventory is always your 5,000, then multiplied by what is the value now of inventory using your variable cost. That means your inventory, you take this figure, you divide it by the unit that you're producing, 75,000, or you can just get it from here. That means times 3.3, because all the units have been valued using variable costs. You do not include fixed costs like the one we did in absorption costing. You only include variable costs. So if you multiply this, it becomes equals, okay, that's where the difference is, right there where we are, times 3.3. Right, so 16,500, the value of closing inventory. This side, the value of closing inventory was 18,800. But here the value of closing inventory is 16,500, because that is the inventory using the variable costing method. We are only including the variable cost there. If we subtract this, okay, I have to put a border there, say equals this, subtract that. If we subtract that, we will find variable manufacturing cost of sales. Okay, variable manufacturing cost of sales is that amount. Then we need to add variable selling and admin. Because we are dealing with marginal costing, all the variable costs have to be treated first. We do not take this figure and put it there like we did in absorption costing, but you need to add the other variable costs that are there. In this case, we have got variable sales and administration costs. So it is 1.45 times 70,000. Okay. And the figure we already got, which is this one. Okay. So after adding these two, then the figure you can put it there. Say equals minus this one plus that. Close your bracket. Okay. Close your bracket there. Then you take these, they should be in a block. Okay, like that. And the figure that you get here is called marginal income. The figure that you get there becomes your marginal income, which is equals to this figure minus that figure, which is called 507,500. After your marginal income, usually I want to bold this one, though I don't put it in italics, I just make it bold. Then you have to say less your fixed cost. Remember, we had not treated any fixed costs here on top. It's unlike your absorption costing when we are mixing. We under absorption costing. Okay, I will make that point clear at the end when I'm explaining the differences between these two methods. Okay, so you say less fixed costs, like I always do, italics and you bolding. Then the first one should be fixed manufacturing costs. Manufacturing costs. What is the fixed manufacturing cost? 34,500. 34,500. Then the next is fixed selling and admin. Fixed selling and fixed selling and admin is 32,000.
3,200.
It's 3,200 or 32,000. Eh?
Yes,
Okay.
300.
Excuse me, what you're saying? Am I right? Right. You add this plus that, you close the bracket, you get those costs. And when you subtract this, that, you get your net profit. You get your net profit there. Okay, let me make this one bold and underline like this. Right. This is your marginal costing method, and that is the absorption costing method. The differences between the two. The differences between the two. The first difference is on absorption costing, the value of inventory of the 1 unit of inventory is R3.76. But how did we get the R3.76? We made sure that all the fixed costs that were there in production and manufacturing, they are included in the value of that inventory. And it seems as if that inventory seems to be overstated under absorption costing. But under marginal costing, the value of closing inventory is less. So, because of the high value of inventory here, it tends to overestimate your profits. It tends to overestimate your profit. Look at the net profit is there. It's 443,300. Here, look at the net profit, it's 441,000. Then the difference here is dividing your costs into production costs or manufacturing costs and then periodic costs, which are your overhead. So the costs that you are dealing with here are manufacturing, and the costs that you are dealing with here are overhead, which is the difference between these two, because here under marginal costing, the costs that you are dealing with at the beginning, they are variable costs, but the costs that you are dealing with here are fixed costs. That is the difference between the two. If you want to check the difference, let me do something here. I want to do some reconciliation so that you can see what is happening. So let me just write reconciliation. Reconciliation there. So I want to say profit as per absorption costing. Profit as per absorption costing. All right. What is the profit as per absorption costing? Profit as per absorption costing is 443,000. Then let's look at the fixed cost. The fixed cost in the closing inventory. The fixed cost in the closing inventory. Right. So I want to take you here. The fixed costs that are in the closing inventory. Your closing inventory, your fixed cost according to the manufacturing fixed cost is 34,500. So I say 34,500 divided by how many units? 75,000. How much does it give you? 34,500. $34,500 divided by 75,000. You get 0.46. So it's 0.46. Then you multiply that by 5,000. We want to look at the fixed cost that is in the closing inventory under absorption costing. So if you multiply it there, what does it give you? Multiply by 5,000. It gives you 2,000. So let me say minus 2,300. If we subtract these two, where is my summation now? Where's my summation? Okay, there it is. All right, so this becomes profit under marginal costing. I've done the reconciliation there. And if you do this, the answers should balance. I think you can see I started with the profit under absorption costing, which is 443,300. Then I had to subtract the fixed cost element that is in the closing inventory. Well, the closing inventory was 34,500 divided by 75,000, the number of units that were produced. We found out that it was 0.46 Rand per unit. The value of that the value of that fixed cost that is in the closing inventory. Then you multiply by the number of the closing inventory, 5,000, to get 2,300. That means 2,300 is the value of the fixed cost that is in the closing inventory. If you subtract it, you should get a profit under marginal costing. You do that, you're home and dry. You can finish with the reconciliation to make sure that your answers are right. If it does not balance, it means you did something wrong. But if you had opening inventory here, it does not balance. If you have got opening inventory here, it does not balance because it also depends on the previous year. Also depends on the previous year. But if opening inventory is 0, that means you can do the reconciliation of the profits. Okay, I can see there are questions. Okay, that's my question. How does one access the recording on Zoom? All right, that one I'll avail it to you. Then I also joined a little bit later because of network issues. Now I'm not following. Don't want to derail the class by asking a lot of questions because I'm behind. I hope you can have access to the recording. Yes, you can have access to the recording in Accenture. All right, guys, let me give room for anyone who wants to ask a question. Anyone who wants to ask a question. Anyone who wants to ask a question. If you want to get hold of me, my direct number is that one, 845-7117. That's my direct number. It comes to me directly. I specialize in these modules, which has got figures. That's what we do. So what I plan to do with you guys is to have free lessons, just teaching you the syllabus, just for interest sake, so that you can have an appreciation of the subject. And I enjoy doing this. All right, any question? Okay,
Jasper?
Yes?
It's Chikoni.
Hi, Chikoni.
So the figures that we need to actually subtract, do we need to put that in brackets?
Yes, you can put them in brackets. If you are writing, you put them in. If you are presenting your work properly, you put them in brackets, or you can just write the minus. You see, there are minuses here. But brackets is neater. Brackets is neater. All right. Thank you so much, but for getting this help. No. You're not going to be investigated. Come on. This is free will. This is from me. Carl, Don't you worry. If you want some personalized help, then you can come to my inbox. All right, guys. So today we are ending here. Unfortunately, we are not going to be able to chat on WhatsApp because WhatsApp is not at back. Yes, WhatsApp is not at back. But you can, what about Telegram? Is Telegram here? Let me see. Someone to answer me, is Telegram there?
I actually think Telegram is working. It's just all the apps that are owned by WhatsApp that's not working. So it's Facebook, Instagram, and WhatsApp.
Okay, I get it. So if you want to chat to me, you can come to Telegram. I'm also there. On Telegram, I'm there with a lot of numbers now. Or someone is asking me, what's your WhatsApp number? You see the number that I've given you, it's a landline, but it's also on WhatsApp. Okay. And also this number, I didn't want to give you a lot of numbers. This number is on WhatsApp. That number is also on Telegram. 071-833-1711. It's on WhatsApp. It's also on Telegram. All right. This number is also on WhatsApp and also on Telegram. Yeah. Innocentia, for ease of communication, you just need to get your Telegram. Yeah, because things are right now, it's better we get to Telegram. It's better we get to Telegram. So what I'm going to do, what can we do to make this group on Telegram now? Oh, let me form a group. Then I send the link there so that people can click on the link and join on Telegram. So please don't disappear. Don't disappear. Do not
Please
disappear.
do that.
Right. Do not disappear, guys. So let me do this.
Casper, whilst you're busy organizing the Telegram, we just want to really say thank you for assisting us. Most people would have actually charged us. So this truly shows that you're passionate about what you do. And we really appreciate it.
Thank you, Whitney. Any day, anytime. So let me try. Or someone can someone start a group on Telegram? Someone who is quick. And they start a group on Telegram, they can just add us and then send us the link to join. Before we miss each other here. Yes, tomorrow I'm going to send a link also for the next class. Tomorrow I'm going to send the link for the next class for question number 2. Today I've done question number 1. So going forward, I'm going to be doing past exam papers. I'm going to be doing past exam papers going forward to prepare you for the online assessments. And please invite your friends, invite the whole class, invite the whole class. I want you all to pass. I want you to invite the whole class. Is there someone who is doing the Telegram group? Just say it, I am, so that you might know. There's someone who is doing? Nobody.
I think we all just trying to download Telegram.
Oh, you serious?
Yeah.
All right, I'm going to form one. So I'm going to say management. Management, accounting. Three. right. I have created the group, so please do not form any other group because I have created it. Okay. I'm going to try and share.
Google is out.
Please don't disappear until I have added the group. I've added the group link. So right. Let me try to do this. So you see what we said that we need. People were saying, no, we don't need Telegram. We don't need Telegram. Now WhatsApp is gone. Oh, I think it's back. I saw a message on Facebook. Is it back? Even Gmail, is Gmail there? Yeah. Okay, let me check my Telegram there. All right, I think I'm almost there. Yeah, Telegram is.
The social media giant Newton showed up with creating great and harming children's mental health.
Let me see. Yeah. If I'm getting there. Telegram.
I want to know how Telegram works.
Copy link. Yeah, got it. All right, there's the link to our group. You can click that link and you join Telegram. And you join Telegram. You got it?
Nothing has come through, Jasper.
All right.
It will come through. I'm seeing it on my side.
All right.
Okay.
Please. Yeah, I can see people joining.
Should I put it? You just say that it's depleting also.
Okay. Right, I can see people are joining in. So I'm going to stop sharing. Hey, there's a lot of people. There's a lot of people. I'm just going to stop the recording.